Let's say you're selling your business for $10 million. That sounds like a great outcome. But then you look closer at the deal structure and realize only $6 million is guaranteed up front. The remaining $4 million is tied to something called an earnout. And that's where things can get complicated. Because depending on how that earnout is structured, you may either receive the full amount or walk away leaving millions of dollars on the table. And before we get started, I'm John Moriarty, co-founder and managing partner at E3 Wealth. We work with business owners on exit planning, deal structuring, and long-term wealth strategy. And today, I want to break down how earnouts actually work and why they're one of the most misunderstood and risky parts of a business sale. At a high level, an earnout is a portion of the purchase price that is contingent on future performance. Instead of receiving the full amount at closing, you receive additional payments over time if certain conditions are met. Those conditions are usually tied to things like revenue targets, EBITDA targets, or other performance metrics. So instead of a guaranteed $10 million sale, you might have $6 million up front and $4 million paid out over the next 2 to 3 years, depending on how the business performs. Here's the issue most business owners don't fully appreciate. After the sale closes, you are often no longer in full control of the business. The buyer can change the cost structure, adjust how revenue is recognized, or shift strategic priorities, all of which can impact whether those earnout targets are actually met. So, if the business performs well in a general sense, you may still fall short of the specific metrics defined in the purchase agreement. That's how earnouts turn into missed payouts. Let's walk through a simple example. You sell your company for $6 million up front, $4 million tied to a 2-year earnout. The earnout is based on hitting certain EBITDA targets. In year 1, the company performs well, but the buyer increases operating expenses, maybe investing in growth. EBITDA drops slightly below the threshold, therefore you receive none of the earnout for that year. In year 2, something similar happens. By the end of the earnout period, you have received 0 of the $4 million. But it's the same business, same underlying performance, but completely different outcome because of how the deal was structured. This is why earnouts aren't just about negotiation. They're about structure. Some of the most important questions include: how are performance metrics defined? Who controls the financial decisions post-sale? Are there protections against changes that can impact performance? And how realistic are the targets based on current operation? 2 deals with the same headline price can have very different real outcomes depending on these details. There's also a tax component that is often overlooked. Earnout payments are typically taxed when they are received, which means you don't get the tax benefit of spreading income unless structured intentionally. And the character of that income, capital gain versus ordinary income, can vary depending on the structure of the deal. In some cases, poor structuring can result in earnout payments being taxed less favorably than the upfront proceeds. So now you're dealing with both performance risk and tax inefficiency. Now, to be clear, earnouts aren't inherently bad. They can be useful when there's uncertainty about evaluation, you want to bridge a gap between buyer and seller expectations, or you're confident in the future performance and terms. But they need to be approached with a clear understanding of the risks. The biggest mistake business owners make in focusing entirely on the headline sale price. But what matters is not what the deal says. It's what you actually collect. And earnouts are one of the biggest variables in that outcome. If you're in the process of selling your business or expect to be in that situation in the next couple of years, understanding how earnouts work are critical, because the difference between a well-structured earnout and a poorly structured one can be measured in millions of dollars. If you'd like help evaluating a deal structure or thinking through how an earnout fits into your broader financial plan, we invite you to schedule a conversation with our team. Because when it comes to selling a business, the goal isn't just negotiating the highest number. It's making sure you actually receive the value of that number. Thank you.